This is The Open on BNN Bloomberg. I'm John Ehrlichman. We want to get to a feature interview now. The market is obsessed with interest rate policy and this worry that higher for longer rates is needed to fight inflation, and that maybe that ultimately will sink the economy. And that's why the work of two economists at the Chicago Fed has been making headlines. Their modeling suggests the U.S. central bank may have done enough to bring inflation back down to target levels without sparking a recession. Stefania D'Amico is one of those senior economists at the Federal Reserve Bank of Chicago, and she joins us now. Thank you very much for your time. We appreciate it.
Thank you for having me. Thank you so much.
Well, we were reviewing the work you've done, and obviously there's a narrative you see out there that there's a really challenging fight against inflation, and despite so many interest rate hikes, it's taking a long time to get back to the so-called target levels. What does your work and modeling tell you about the impact of the interest rate hikes that we've already seen from the U.S. Federal Reserve?
So our model is, first of all, is a joint work with Thomas King, and the main difference from previous model is that this model takes into account a measure of expectation and especially expectation of the interest rate. And this type of statistical model is predicting using data up to July 2023 that by the mid of 2024 the inflation will get near to target while there will be no recession. But it's very important to keep in mind that these forecasts have very large uncertainty band around it, and they're taking into account of data only up to July 2023, so they don't account for more recent shock that made the economy.
So certainly you'll have to continue looking at the data, just like the U.S. Federal Reserve itself is looking at all the data. But the modeling based on some of those summer numbers suggests that maybe the Fed's inflation target is reached by sometime in 2024. Now, you mentioned expectations. I think a lot of people talk about when interest rate increases impact the economy. It sounds to me, based on the work you've done, that messaging about higher interest rates, that has had an impact on getting inflation back to potentially those target levels. Can you walk us through that part of the research?
Yes, so the idea of the model is to try to take into account that since the global financial crisis, when the policy rate hit the zero lower bound, the Federal Reserve have been relying a lot on forward guidance to shape interest rate expectation when the policy rate was at zero. And then, since then, forward guidance has been used more often and more explicitly. And the idea is that if you start using forward guidance before you move the actual policy rate, interest rate expectation will start changing before an actual change in the policy rate, and therefore this is going to give an head start to the impact on the economy. So just to make an example, in this particular tightening cycle, interest rates, in particular the two-year yield, was already up almost 200 basis points before the actual interest rate hike in March 2022. This means that if interest rate expectations start moving ahead of the actual policy rate change, then people will act on this expectation and actual variable will start changing in advance, giving the impression that the actual impact of monetary policy is happening faster, and therefore the legs of monetary policy are shorter.
That's really helpful context. In the broader market, there's a dialogue right now around the idea of higher for longer interest rates, a belief that progress has been made on inflation, but to ensure that inflation remains at that target level, that central banks have to keep interest rates elevated for some time. If people look at your modeling, and I know it's just based on data up until the summer, but if they look at your modeling and it suggests that the Fed's inflation targets will be met by the middle of next year, does that imply or suggest that the Fed could start reducing interest rates at some point soon?
So first of all, it is important to keep in mind that this is just one of the main models the Fed looks at, because that is proper risk management, to look at multiple models at the same time, because each model is an imperfect representation of reality and has a lot of assumptions. And moreover, these forecasts have a lot of uncertainty, statistical uncertainty and model uncertainty around them. But given the fact that the model predict that inflation will be under control by mid-2024, this is more or less where the interest rate path will reach peak according to the model.
Okay. Are there other considerations that you can model for? Maybe you can't model for? You know, we've talked about geopolitical risk, for example, and whether that played a role in this inflation story that we couldn't have seen coming. What are some of the considerations that you'll have to look at to determine whether or not the inflation target ultimately can come down to those, you know, those targeted levels, let's say by the middle of 2024?
Well, first of all, the model does not take into account of any international variable, is using only domestic US variable. And the only way global risk consideration would enter, it would be to the 2-year and 10-year treasury yields, and most likely through the risk premium on these yields. But the model does not account for international variable.
Okay. So a final question then, because what I didn't highlight, but what your modeling also found was that if inflation can reach those target levels, we could see a scenario for the U.S. economy that avoids some of the major recessionary concerns some have pointed to. Some have described what you've concluded here as a so-called Goldilocks economy. Can you just explain what the modeling tells you on that front?
Sorry, can you repeat a little bit the question?
Well, it sounds like you don't see significant deterioration in the economy, which is something that some people have been fearful of during this interest rate hike cycle.
Yeah, that is correct. So far, the model, again, using only data up to July 2023, does not forecast a recession in the median forecast. But if you look at the uncertainty band around the real growth forecast, you can see that the lower bound of this band can include a very mild recession at the end of the year. So, as I said, because the uncertainty around the forecast is large, a mild recession is included in these possibilities.
Okay.